Our next guest is moderately bearish on energy fundamentals for the fourth quarter and sees limited near-term upside for crude. Francisco Blanch is the head of global commodity research at Bank-America-Merrill Lynch. He's a Bloomberg best forecaster on energy prices. That means he has a great track record, so listen to what he says. Francisco, why are you moderately bearish on oil going forward?
Well, look, I think the economy globally is decelerating. We have a pretty substantial decay in economic activity across many nations, and we still have a lot of uncertainty around the European situation. So, to me, all those factors are going to put downward pressure on consumption of energy, and particularly oil, over next quarter or two. And then I do expect policymakers to come in and provide good support to the market. We saw the Bank of England yesterday doing quantitative easing again, and who knows, we may get the Fed to do something similar in the next 2 or 3 months if the economy continues to soften up. And finally, we have the European Central Bank, which I think is also going to come to support the markets in the next 2 or 3 months.
If you expect, for example, quantitative easing, the Fed actually printing more money to buy assets, you know, the last couple times we've seen that, obviously a huge run-up in commodities prices. Right. Wouldn't you expect oil to move up as well in that case?
I do, but I do think that things need to get worse before they get better. So that's why I'm moderately bearish on energy. I don't think the Fed is at a point right now where it feels confident to embark on further additional easing measures. So you know, I think the economy is probably going to continue to move south in this trend for a little bit longer, dragging energy down with it. And like I said, I think sometime in the next 3 months or 4 months, we will get more policy support. But remember, there's one big question mark here: is what happens to the Greek default? You know, people have been waiting for a default in Greece. Hasn't happened yet. Once it happens, if it happens, we will get a lot more clarity as to how this will impact financial institutions in Europe, and particularly how it impacts Portugal, how it impacts Spain and Italy. So I think there are a lot of question marks that need to be resolved before oil can move back on an upward trend.
Hey, just got a screen here from a viewer, a buddy of mine, David Stroud, who trades commodities. I'm looking at copper down 25% year to date. Do you expect industrial metals to keep seeing this kind of weakness if you expect the economy to keep looking bleak globally?
Globally, we think industrial metals probably have some downside here at these levels. Now, it depends really what happens to China. Our view on China, our economics view on China is that we still believe Chinese growth will be around 9% in terms of GDP in 2012. So as long as that doesn't change, we see a little bit of downside, but not huge downside to cyclical commodities such as energy and metals. And we do think that if prices come down another 5 or 10%, there will be a strong incentive for the Chinese to come in and start restocking copper. So there's a little bit more downside, but not a huge amount. We don't see a hard landing in the China economy. We see more of a moderation with growth remaining at relatively strong levels still.
What do you see, Francisco, in regards to gold? I mean, we've seen an incredible drop after really an incredible run-up, right? I mean, $1,900 and change. Now we're looking at $1,600, so basically a drop of $300. A lot of guys down here have been talking about for weeks when to get back in, because pretty much everyone sees upside in the medium to longer term, but in the short term, people are talking about $1,400 as a level to watch for a bottom.
Well, look, I think gold is going to hold up pretty well. We don't see a breakdown here. We think that there are 3 key trends that need to change before you move into a bear gold market. Trend number 1, you need to see higher nominal interest rates in the U.S., and the Fed has already said that they're not going to change that for at least 2 years. You need a bullish dollar trend, and that's maybe more of a question mark. Maybe some of the repatriation of dollars into the U.S. could impact this trend, but on a longer-term basis, we still see a weaker dollar ahead. And I think the number 3 trend is you probably need to see a bear market in oil, and that's pretty far away too. We need to see that shale oil production continue to permeate through America, changing the dynamics of energy consumption in this country. So it's all tied up together, if you see what I mean. I think for gold to start turning on a more permanent basis, you really need those 3 trends: a bear trend in oil, a bear trend in the dollar, and higher nominal rates to really bring gold prices a lot lower than these levels.
All right, hey, great. Francisco, thanks so much for joining us. Francisco Blanch there from Bank of America Merrill Lynch. He is a Bloomberg best forecaster of energy prices, why we listen closely to what he has to say. Great track record.